And I think you have to kind of take a step back and see what the biggest players in the world are doing. And the biggest players are the central banks who are massively de-dollarizing and buying commodities. And I think that's kind of the thrust that fits hand in glove with Zoltan Pozsar said. We are heading into a new era based on commodities and transparency, not opaque debt instruments and promises that seem to fall short. And I just think that this is something that will be a very, very...
I don't see this going much longer. Because people are being driven crazy. Nobody has any savings anymore, so production is being sucked into oblivion, and eventually when we can no longer produce and we're busy just like making money through basis trade, shuffling paper, and that's where the money's coming from, and nobody's producing anything anymore, then what? How can this continue?
You're watching Silver News Daily. Like this video and subscribe to the channel for the best news that you don't want to miss. Now let's get straight to it. The American economy, a titan of strength and resilience, now teeters on the brink of an abyss. It's not just the usual market fluctuations or economic downturns we're talking about here. This is different. This is the US government, the supposed bastion of global financial stability, steering the country towards a precipice that could lead to its downfall. Amidst this unfolding drama, the world watches in disbelief as America's rivals band together under the BRFCS alliance, fortifying their financial defenses against a potential dollar collapse. And in the midst of this chaos, whispers from the market's underbelly suggest an extraordinary phenomenon: the value of silver skyrocketing to an astonishing $3,888. You heard it right, $3,888. Market maestros Andy Schectman and Rafa Farber have echoed these sentiments in their recent bombshell interviews, painting a picture of a financial landscape on the cusp of a seismic shift. Stay tuned as we unravel this complex tapestry, stitch by intricate stitch, and reveal how the convergence of these seemingly disparate elements could orchestrate the fall of a giant and the meteoric rise of silver. If this revelation isn't a clarion call to the astute and the savvy, what is? Prepare to dive into a narrative that defies the norms, challenges perceptions, and breaks the mold of financial discourse. The stage is set, the players are in motion, and the story of a lifetime is about to unfold. In a world brimming with economic complexities and geopolitical chess games, it's not just the markets that are whispering. It's a resounding alarm bell, heralding an era of unprecedented financial turbulence. The stage is set and the players are in motion, but this isn't your typical Wall Street saga. This is a tale of nations, of silver, and of the seemingly inevitable downfall of a titan. As the US government, a monolith of financial might, navigates through the murky waters of international finance, it's not just navigating, it's inadvertently charting a course towards its own demise. How, you ask? The answer lies not within, but beyond its borders, where America's biggest rivals are not just watching, they're uniting. Enter BRICS, an alliance of nations that's not just an economic bloc, but a formidable counterforce to the Western financial hegemony. This coalition isn't just sitting back, it's strategizing, it's mobilizing, and it's backing its currencies with a force that could potentially dethrone the almighty dollar. But that's not all. Amidst this geopolitical turmoil, there's a glint not just of hope, but of silver. Yes, silver, the underdog of precious metals that's poised to not just rise, but skyrocket to a staggering $3,888. It's not a prophecy, it's a prediction. A projection rooted in the meticulous analysis of market gurus Andy Schectman and Rafa Farber. Their voices aren't just echoing through the canyons of finance, they're resonating with the pulse of the market, predicting a seismic shift in the value of silver that's not just unprecedented, it's almost unthinkable. But how does this all come together? How do the geopolitical machinations of nations and the surge in silver intertwine to script the narrative of financial upheaval? The answer to this enigma isn't straightforward. It's a puzzle, a complex mosaic of international relations, market dynamics, and economic strategies. As we delve deeper into this narrative, we'll not just explore, but dissect these elements. We'll unravel the intricacies of the silver market, the strategic maneuvers of BRICS, and the potential repercussions on the global financial stage. This isn't just a story, it's an odyssey, a journey through the labyrinth of global finance where each turn, each twist, and each revelation brings us closer to understanding the impending reality of a world where the dollar's reign is challenged, where silver reigns supreme, and where the economic order as we know it is on the brink of a transformation. But words can only convey so much. To truly grasp the gravity of this situation, to truly comprehend the magnitude of these predictions, we turn to the visionaries themselves. In a moment, we'll be playing a short clip, a snippet of the profound insights shared by Andy Schectman and Rafa Farber in their latest interviews. Their analysis isn't just commentary, it's a window into the future, a glimpse of what might lie ahead in this tumultuous financial saga. So prepare to listen, to watch, and to ponder as we present a segment that's not just informative, it's transformative. And as you immerse yourself in their words, remember, this isn't just about understanding the market. It's about envisioning the future of finance, a future where the unexpected becomes the inevitable.
As time goes back, you'll see a 16-to-1 ratio gold to silver until just recently, where guys like Keith Neumeyer, who you've had on your show, I believe, will say it's coming out of the ground right now at 7-to-1, and he would know. He's the CEO of one of the largest silver mining companies in the world and understands this. So it's an asset that is depleting in nature. It is depleting above ground, and it is increasing in its use cases. So I will still say, yes, it is. And it to me is somewhat surprising that the ratio has stayed where it is for as long as it has. And again, I will tell you that I don't see a better calculated speculation, maybe never have in my career. And it checks all the boxes and has very little downside risk. I guess the one fatal flaw perhaps in this plan would be you do this and gold becomes unobtainium. Now, could that happen? Sure. Nothing surprises me anymore, but I will tell you, strictly from a mathematical and logical perspective, I don't think there's a better play out there whereby you can increase the amount of gold you ultimately end up with without spending any money. And in my opinion, really, without, in fact, maybe even decreasing your risk, because the downside risk of silver priced at 22, 23 bucks an ounce, to me, is completely negligible. And the one or two times that we've seen the markets in the last decade act irrationally, like we saw in 2020, where silver went down to 12 bucks, you'll remember, Dunnigan, you couldn't find a thing on the planet for, at least double that make-believe melt price, make-believe spot price. So yes, I still believe it. Yes, I still think it's as good of a deal as it ever was, or as smart of a deal, to the point where I will publicly say I think it is.
Emerging from the depths of the silver market's complexities, Andy Schectman's insights illuminate a path not just paved with silver, but lined with astute calculations and historical precedents. As we delve into this segment, we're not just dissecting numbers, we're unraveling a narrative that has been centuries in the making. Schectman doesn't just speak. He resonates with the pulse of the market, echoing the sentiments of visionaries and mining magnates like Keith Neumeyer. The historical 16-to-1 gold-to-silver ratio isn't just a number, it's a testament to the intrinsic value and geological scarcity of these precious metals. But today's market isn't just diverging from this historical norm, it's charting a course towards uncharted territories. As Schectman elucidates, the ratio has dramatically shifted, with silver emerging from the ground at a staggering ratio of 7-to-1. This isn't just an anomaly, it's a clarion call to those attuned to the subtleties of the market. But why does this matter? Why should a mere shift in the extraction ratio command our attention? The answer lies not just in the numbers, but in the narrative they weave. Silver, as Schectman insightfully points out, is not just being extracted, it's being depleted. Its presence above ground isn't just diminishing, it's being devoured by an insatiable demand, a demand driven by its myriad industrial applications from photovoltaics to medical technologies. But there's more. This narrative isn't just about consumption. It's about speculation, about the calculated gamble that could redefine the portfolios of the prudent. The gold-silver ratio, historically a beacon of stability, now teeters on the edge of a precipice. Schectman doesn't just observe this, he challenges it, positing that the realignment of this ratio isn't just probable, it's potentially profitable. Consider this. Silver, currently hovering around $22, $23 an ounce, carries with it not just value, but a promise underscored by the minimal downside risk. The market, though often capricious, has shown us glimpses of this potential. The 2020 market anomaly, where silver plummeted to $12 an ounce, wasn't just a downturn, it was a revelation. It revealed a market that, even in its most irrational moments, couldn't undermine the intrinsic value of silver. Schectman's perspective isn't just grounded in historical precedents or market trends, it's anchored in a fundamental belief in the logical and mathematical underpinnings of market dynamics. The silver market, with its current valuations and historical ratio disparities, presents not just an opportunity, but a strategy that isn't about mere acquisition, but about strategic realignment, about leveraging the potential reversion of the gold-silver ratio to not just preserve wealth, but to augment it. In this segment, we don't just take Schectman's word at face value. We corroborate it with historical data, market trends, and logical deductions. We're not just passive observers, we're active participants navigating through the intricacies of the market, armed with insights that aren't just thought-provoking. They're potentially transformative. So, as we ponder the potential of silver, let's not just reflect on its current valuation. Let's envision its trajectory, a trajectory that's not just promising, but grounded in the bedrock of historical precedents, geological scarcity, and market dynamics. And as we continue this journey, remember the market isn't just a battleground of numbers, it's a narrative woven with the threads of risk, reward, and relentless speculation. As Sheckman reminds us, the path to wealth isn't just paved with gold, sometimes it's lined with silver. As we transition from the profound insights shared by Andy Sheckman, it becomes increasingly clear that we're not merely spectators in the financial market's grand theater. We are participants in a narrative that's rapidly unfolding, a narrative that's as compelling as it is complex. Sheckman's perspective on the silver market isn't just an analysis, it's a prelude to a broader understanding of the intricate dynamics that govern the financial ecosystem. The revelation of the silver extraction ratio plummeting from the historical 16-to-1 to a staggering 7-to-1 isn't just a statistic, it's a beacon that illuminates the path forward. This dramatic shift isn't merely a fluctuation, it's a testament to silver's growing scarcity and its burgeoning significance in the global market. As we delve deeper into the narrative, the connection between Sheckman's insights and the initial phrase becomes unmistakably clear. The silver market is on the cusp of a transformation, one that could redefine its role in the financial hierarchy and corroborate the staggering prediction of silver reaching $3,888. But why should this revelation command your attention? Why should the recalibration of the gold-silver ratio resonate with anyone keeping a vigilant eye on the market? The answer lies in the undercurrents that drive the market, undercurrents that are not just about supply and demand, but about perception, speculation, and the unyielding quest for stability in an increasingly volatile world. The notion that silver could ascend to unprecedented heights isn't just a hypothesis. It's grounded in a meticulous analysis of market trends, historical data, and most importantly, the intrinsic value that silver brings to the table. As Sheckman elucidates, the strategy isn't just about capitalizing on the potential reversion of the gold-silver ratio. It's about understanding the fundamental forces that drive the market, forces that are as relentless as they are unpredictable. And as we stand on the precipice of this potential financial paradigm shift, it's imperative to not just comprehend the factors that drive the silver market, but to anticipate the reverberations that such a shift could engender across the financial landscape. This understanding isn't just crucial, it's indispensable for anyone keen on navigating the tumultuous waters of the market with acumen and foresight. But the narrative doesn't end here. As we eagerly anticipate the next video featuring Raphael Farber, we're not just awaiting another perspective. We're gearing up for a continuation of a discourse that's as enlightening as it is transformative. Farber's insights aren't just complementary to Sheckman's. They're a crucial piece of the puzzle, a piece that could potentially validate the initial phrase and fortify our understanding of the silver market's trajectory. So as we build up anticipation for Farber's perspective, let's not just focus on the impending revelation. Let's reflect on the journey thus far, a journey that's not just about understanding the market, but about envisioning its future, a future where the unlikely becomes the inevitable, where predictions become reality, and where the value of silver transcends expectations, solidifying its stature in the annals of financial history. Stay tuned, for this narrative is far from over. The stage is set, the players are ready, and the next act promises to be as riveting as it is revealing.
I don't know that for certain, but if you look at the shape of pretty much any of the parabolic curves, whether you measure that by federal debt deficits or the money supply or the Fed's balance sheet following an exponential curve since 1913. I mean, it's all the same curve. So, I mean, at some point, it just gets too high, too fast. And if I can triangulate it with how non-productive society appears to be at this point in our history, then and if we assume, which I do, that inflation and societal sanity, let's call it, are proportional, then I don't see how we can continue to function this way when systems are becoming so obviously corrupt that anything beyond this, if the inflationary system can sustain itself for, say, another 5-10 years, we could get into a situation where we have real global tyranny that looks like something out of the Soviet Union or Nazi Germany, something like that, all over the world. And that's not a world that I'm prepared to live in. So call it a prayer and me banking on the shape of parabolas, but I don't see this going much longer because people are being driven crazy. And nobody has any savings anymore. So production is being sucked into oblivion. And eventually when we can no longer produce and we're busy just like making money through basis trade, shuffling paper, and that's where the money's coming from, and nobody's producing anything anymore, then how can this continue? I don't see it. At least I really hope it doesn't last another 5 years, because I don't know if I could.
As we transition from the silver market intricacies illuminated by Andy Schectman, Raphael Farber introduces a broader, more macroscopic perspective on the global financial system. Farber's narrative isn't confined to the precious metals market. It's a sweeping overview of the systemic issues plaguing our economic framework, a framework that's teetering on the edge of a precipice, not just financially, but societally. Farber's observations on the parabolic curves of federal debt deficits and the money supply aren't just economic metrics, they're harbingers of a deeper, more systemic malaise. These curves, following an exponential trajectory since 1913, aren't just numbers. They're a testament to a century-long trend of unfettered expansion, a trend that, as Farber astutely notes, is unsustainable. The exponential growth in these metrics isn't just alarming, it's indicative of an underlying pathology, a pathology characterized by rampant inflation, dwindling productivity, and a societal structure that's increasingly fraying at the seams. But Farber's narrative isn't just a critique, it's a prognosis that's as grim as it is grounded in reality. The correlation he draws between inflation and societal sanity isn't just a conjecture, it's a profound observation on the symbiotic relationship between economic stability and social cohesion. As inflation erodes the value of currency, it doesn't just deplete savings, it undermines the very fabric of society, catalyzing a descent into what Farber poignantly terms global tyranny, a scenario reminiscent of the darkest chapters in human history. This descent isn't just a financial crisis, it's a societal unraveling where the mechanisms of production, the bedrock of any economy, are supplanted by a frenetic, almost frenzied fixation on wealth preservation, a scenario where the generation of real, tangible value is overshadowed by the ephemeral allure of financial speculation. In Farber's narrative, the market isn't just a platform for economic transactions, it's a mirror reflecting the state of society, a society that's teetering on the brink of an abyss, not just economically, but existentially. How does this tie back to the initial phrase and the silver market? It's not just a connection, it's a confluence of economic indicators, market trends, and societal dynamics that paints a picture of an impending paradigm shift. The surge in silver prices predicted by Schectman isn't just a market anomaly, it's a symptom of a broader, more systemic malaise, a malaise characterized by the devaluation of fiat currencies, the erosion of societal trust in traditional financial institutions, and the quest for tangible intrinsic value in a world that's increasingly intangible. As Farber eloquently articulates, this isn't just about market dynamics, it's about the very fabric of society, a fabric that's increasingly threadbare, strained by the relentless pressures of inflation, speculation, and the systemic erosion of trust. The surge in silver isn't just an investment trend, it's a beacon signaling a return to tangible value in an era defined by its absence. In this narrative, silver isn't just a commodity, it's a symbol of stability, of intrinsic value, and perhaps most importantly of hope that amidst the swirling vortex of economic turmoil, societal instability, and the relentless march of inflation, there exists a haven not just for wealth, but for sanity, a sanctuary where the tangible prevails over the transient, where value is not just preserved, but revered. As we eagerly anticipate the unfolding of this narrative, let's not just focus on the numbers, let's ponder the broader implications, the societal ramifications, and the potential for a return to a financial paradigm that's not just sustainable, but equitable, a paradigm where silver isn't just a commodity, but a cornerstone of a new economic edifice, one that's as enduring as it is equitable. In the previous segment, Raphael Farber laid bare the underlying currents of our global financial system, revealing not just the symptoms of an ailing economy, but the systemic issues at its core. His insights painted a stark picture of an economic framework under siege, strained by exponential growth in debt deficits and an increasingly volatile money supply. As we assimilated these revelations, a broader narrative began to emerge, one that resonates deeply with the initial phrase and adds a profound dimension to our understanding of the silver market's potential transformation. Now, as we step into this segment, we're not merely continuing a discussion, we're connecting the dots, weaving together the insights from Farber with the fabric of the larger narrative, reaffirming the profound implications of what was initially posited. the looming potential for silver to soar to unprecedented heights. The intertwining of Farber's prognosis of the economic system with the trajectory of the silver market isn't just a correlation, it's a causation. The exponential curves of federal debt and the money supply, symptomatic of a deeper malaise, are not isolated from the realm of precious metals. Instead, they're intrinsically linked, each echoing the turmoil of the other. As Farber elucidated, the relentless expansion of debt and the dilution of currency don't merely erode economic stability, they drive a quest for tangible intrinsic value. A quest that finds its answer in the latent potential of silver. The implications of this are profound. The anticipated surge in silver prices, as echoed by market maestros like Andy Schectman, isn't merely a speculative bubble. It's a rational, almost inevitable response to the systemic erosion of trust in fiat currencies and traditional financial institutions. The quest for silver isn't just a hedge against inflation. It's a pursuit of stability, a return to tangible value in a world increasingly dominated by the intangible. As we reflect on Farber's insights, the initial phrase about silver's potential ascent to $3,888 gains not just credibility, but a sense of inevitability. The convergence of economic instability, societal unrest, and the relentless pursuit of tangible value doesn't just set the stage for silver's rise, it virtually propels it. But our narrative isn't complete. As we eagerly anticipate the next segment featuring Andy Schectman, we're not merely awaiting further analysis. We're preparing for a continuation of a discourse that's not just about the silver market, but about the very underpinnings of our global economic and societal structure. Schectman's insights, grounded in a deep understanding of the precious metals market, are not just complementary to Farber's, they're instrumental in piecing together this intricate puzzle. So as we build up anticipation for Schectman's perspective, let's not just focus on the impending discourse. Let's ponder the journey thus far, a journey through the labyrinth of global finance and societal dynamics, a journey that's not just about understanding, but about envisioning the future, a future where the value of silver transcends market predictions, becoming a beacon of stability in an era of uncertainty. Stay tuned, for the narrative is far from over. The next segment promises not just insights, but revelations that will not just validate the initial phrase, but will offer a deeper, more nuanced understanding of the forces that shape our economic destiny.
And, one of these things that I would call maybe the greatest calculated speculation I've ever seen, I think it's the trade of a generation. I don't say that lightly. I will be the first to admit I'm surprised it has stayed here where it has. But to what Rick had said, what Rick was saying was that gold in the previous four bull cycles led the way. Well, that's exactly what gold is doing here. And what he would also say is that when silver finally caught up in terms of a percentage gain, it catches it and actually surpasses it in terms of its performance. And when you look at silver from every single metric, aside from the fact that it holds the largest concentrated short position on any commodity traded on the exchange, which just reeks of manipulation, it is an asset that is increasing exponentially in its demand in green, in digital, and military applications, not to mention monetary, and it is decreasing in its above-ground footprint. It's also decreasing in its below-ground footprint in the respect that what it is used in industrial applications or military applications, it is used and it is gone. It is, in terms of recycling, very little silver is recycled because it's used in such small amounts in motherboards or in cell phones or basically anything that conducts electricity or is electronic has a little bit of silver in it. Doesn't make sense to recycle it out. Or if it's used in the tip of a Tomahawk cruise missile, you're not going to dig amongst a crater where the bomb went off looking for residues, silver residue. My point is that it is decreasing above ground in its industrial and military applications, and it's decreasing below ground in the respect that for 5,000 years, the ratio of 16 ounces of silver to 1 ounce of gold not only was consistent in its price, but it got that price ratio because of.
In this compelling segment, Andy Schectman not only reaffirms his stance on the silver market, but also enriches our understanding with an astute analysis that intertwines historical data, market dynamics, and industrial demand. His discourse is not just an overview, it's a profound exploration of silver's multifaceted role in the global economy, a role that's as intricate as it is impactful. Schectman characterizes the current state of the silver market as the greatest calculated speculation he has ever seen, terming it the trade of a generation. This isn't a statement made lightly. It's a testament to the profound potential that silver holds in the current economic climate. The historical precedence of the gold to silver ratio, which stood steadfast at 16, to one for millennia isn't just a number, it's a reflection of the intrinsic value and scarcity of these precious metals. However, the contemporary landscape reveals a stark deviation from this historical norm, underscoring the untapped potential of silver. The narrative that Shechtman weaves isn't confined to historical ratios. It delves into the very heart of market dynamics. He sheds light on the significant role that silver plays not just in the financial markets, but in various industries. The metal's increasing demand in green technologies, digital applications, and military sectors isn't just a trend. It's a testament to its indispensable utility and burgeoning significance. This multifaceted demand, coupled with the finite nature of silver resources, paints a picture of a market that's not just growing, but poised for a substantial revaluation. Shechtman's insight into the concentrated short positions in the silver market is particularly revealing. This observation isn't just a critique of market manipulation, it's an indication of the underlying volatility and potential that the silver market holds. The fact that silver has the largest concentrated short position of any commodity traded on the exchange signals not just market sentiment, but also the immense speculative potential that lies within. Moreover, Shechtman elucidates the critical aspect of silver's consumption and scarcity. The metal's decreasing above ground and below ground footprint is a stark reminder of its finite nature. The fact that very little silver is recycled due to its extensive use in minuscule quantities across a plethora of applications underscores its perpetual demand. Whether it's in electronic devices, green technologies, or military applications, once silver is used, it's often irrecoverable, thereby diminishing its available supply and enhancing its intrinsic value. As we assimilate Shechtman's insights, the connection to the initial phrase becomes unmistakably clear. The anticipated surge in silver's value to $3,888 isn't just a speculative statement. It's a projection grounded in a deep understanding of market dynamics, historical trends, and the metal's indispensable role across various sectors. The convergence of silver's increasing industrial demand, its decreasing supply, and the historical precedence of the gold-to-silver ratio sets the stage for a potential revaluation of silver, a revaluation that's not just plausible, but grounded in a confluence of compelling factors. In this narrative, silver emerges not just as a commodity, but as a cornerstone of modern industry and a beacon of value in an increasingly volatile market. As we continue to unravel the intricacies of this narrative, it becomes evident that the potential ascent of silver isn't just a possibility, it's a culmination of factors that resonate deeply with the foundational principles of supply, demand, and intrinsic value. As we delve deeper into the intricacies of the silver market, Andy Shechtman's compelling insights in our previous segment not only reinforce the profound potential of silver, but also paved the way for a broader understanding of its imminent significance. Shechtman's analysis isn't merely an observation, it's a resounding affirmation of the latent potential that silver holds in an economy marked by volatility and an increasing quest for tangible assets. In the previous segment, Shechtman articulated a vision of silver that transcends its current valuation, highlighting its pivotal role across industries and its diminishing supply both above and below ground. This vision isn't just a forecast, it's a profound understanding of market dynamics and the intrinsic value of silver, substantiating the assertion that silver is not just poised for an increase in value, but it is on the cusp of a transformative revaluation. As we connect the dots between Shechtman's insights and the initial phrase about silver reaching $3,888, the narrative becomes increasingly compelling. The convergence of silver's multifaceted industrial demand, its dwindling supply, and the historical precedence of the gold-to-silver ratio doesn't just hint at the potential for silver's ascent, it virtually cements its inevitability. The profound disparity between the historical ratio and the current valuation of silver isn't just an anomaly, it's a glaring indicator of silver's undervaluation and its potential for an unprecedented surge. The narrative we've been unraveling isn't confined to the dimensions of supply and demand or industrial utility. It's a reflection of a broader economic paradigm, a paradigm characterized by the search for stability and intrinsic value in a landscape marred by the erosion of traditional financial instruments. In this context, silver emerges not merely as a commodity, but as a bastion of stability, a tangible asset that stands as a bulwark against the capriciousness of fiat currencies and the volatility of financial markets. But our narrative is far from complete. As we eagerly anticipate the next segment featuring Rafa Farber, we're not merely transitioning to another perspective. We're preparing for a deeper dive into the economic undercurrents that underscore our discourse. Farber's insights, renowned for their depth and foresight, promise not just to complement the discourse thus far, but to provide a critical analysis of the broader economic indicators and their implications for the silver market. So as we build up anticipation for Farber's forthcoming insights, let's not merely await his perspective. Let's reflect on the journey thus far, a journey that's not just about understanding the potential ascent of silver, but about comprehending the broader economic forces at play. A journey that's about envisioning a future where silver's value transcends its current perception, heralding not just a surge in its valuation, but a paradigm shift in our understanding of tangible assets and their role in an evolving economic landscape. Stay tuned, for the narrative is about to be enriched. The next segment promises not just insights, but a profound exploration of the economic indicators that shape our reality, an exploration that will not just validate the initial phrase, but will offer a deeper, more nuanced understanding of the forces that drive our economic destiny.
A basis trade is just when hedge funds or any trader with basically a futures brokerage account, even I could do it theoretically, if I had access to the repo market through another broker that has access to the repo market. Well, theoretically, my brokerage does have access to the repo market, so I could access that if I wanted to. But anyway, for reasons of leverage, which are just statutory, there's a price differential between cash bonds. Let's say a 2-year bond you can buy for X amount of money, and a futures you can buy for a little bit. It's a little bit more expensive, like by fractions of a penny. One of the reason is that you can get exposure to the same securities, so it's legally the same thing, but you only put up a fraction of the money to get that same exposure. Like, for example, when you buy a gold futures contract, you have exposure to 100 ounces of gold, but you only put up like a few percent margin. I forgot what the exact number is, but it's in the single digits, I think. Let's just say 10%, I don't know. So you have to put up less money to get that exposure. So for bonds, that means that the futures, the nearest future bond contract is cheaper than the cash bond contract. So not the actual cash bonds that you buy, like the paper. So what hedge funds will do is basically sell the futures and then buy the paper to cover, so it's it's not a naked short, and then they wait for the futures contract to expire, and then it converges on the cash price, and then they are able to net a fraction of a penny on that trade. So a fraction of a penny is not going to get you that much money. So what you have to do is you have to borrow like hundreds of billions of dollars in the repo market and do it over and over and over and over again. And then you can multiply that fractions of a penny by many millions of times, and you end up with, I think one of these hedge funds ended up with a profit of 1.5 billion or something like that. So whether that's all from the basis trade or whether it's just a few $100 million, it's basically free money if everything doesn't crash. Then the thing that could go wrong with it is if there's not enough money in the repo market to cover the trade that they need to cover for that day, then repo rates can jump up to, let's say, what happened in the repocalypse, like 10%, and then all of a sudden their costs of executing the trade exceed their profits from it, and then they have to unwind everything really quickly, and then what happens is like the funds that were short the futures, all of a sudden they have to buy it back really quickly, so the price of the futures shoots up as they have to cover it, and then interest rates on the 2-year go down, but interest rates on the repo go up, and then you have this like jagged action on the yield curve that messes up pretty much every derivative that's based on it, which is like interest rates for everything from renting a car to mortgages, etc. And then nothing makes any sense anymore financially, and the Fed has to intervene.
In this insightful segment, Rafael Farber introduces us to the intricate world of basis trades, emphasizing its profound implications for the financial markets and, by extension, the precious metals market, especially silver. Farber doesn't just describe a trading strategy. He delves into the heart of the financial system, shedding light on the complex interplay between leverage, market liquidity, and monetary policy. Farber elucidates the concept of the basis trade, a strategy predominantly employed by hedge funds and traders with access to futures and the repo market. The essence of this strategy lies in exploiting the price differential between cash bonds and futures contracts, leveraging the marginal difference to net substantial gains. This process isn't just a testament to financial acumen. It's a reflection of the intricate dynamics that govern the financial markets, where minor discrepancies can translate into significant profits. However, as Farber astutely points out, this strategy isn't without its perils. The dependency on the repo market for liquidity introduces a vulnerability. A scarcity of funds in the repo market can precipitate a spike in repo rates, disrupting the delicate balance of the basis trade. This disruption isn't merely a financial inconvenience, it's a potential catalyst for market instability where the rapid unwinding of positions can lead to volatile price actions, not just in the bond market, but across the financial spectrum. This nuanced analysis of basis trades and the repo market carries profound implications for the silver market. The heightened volatility and potential liquidity crisis underscored by Farber could lead to increased market uncertainty, prompting investors to seek refuge in tangible assets like silver. Moreover, the systemic risks highlighted by the basis trade strategy resonate with broader market sentiments, where concerns over market manipulation, inflation, and economic instability drive investors towards safe haven assets. Furthermore, the potential intervention by the Federal Reserve in scenarios of market distress, as indicated by Farber, adds another layer of complexity. Such interventions, often in the form of monetary easing or liquidity injections, can devalue fiat currencies, making assets like silver more attractive. Silver, with its dual role as an industrial metal and a monetary asset, stands to benefit from both an increase in industrial demand and a surge in investment demand as a hedge against inflation and currency devaluation. In essence, Farber's analysis of the basis trade and the repo market isn't just an exposition of a financial strategy. It's a narrative that intertwines market dynamics, monetary policy, and the inherent value of silver. It's a narrative that reaffirms the initial assertion regarding silver's potential ascent in value, highlighting how systemic vulnerabilities and the quest for stability in an increasingly uncertain financial landscape can catalyze a transformative revaluation of silver, solidifying its position as a prudent and potentially lucrative investment in the times to come. We reach the climax of our journey intertwining the insights gleaned from the overarching narrative, the potential ascent of silver to the unprecedented value of $3,880. Raphael Farber's elucidation of the basis trade in the financial markets offers a profound understanding of the intricate mechanics that govern our financial system, particularly highlighting the delicate balance between risk and opportunity. As we've unraveled through Rafi's insights, the basis trade exemplifies not only the sophistication of financial strategies, but also the inherent fragilities within the system. The crux of this strategy, leveraging the minute price differentials between cash bonds and futures contracts, sheds light on the intricate dance of liquidity, leverage, and market dynamics. This strategy, while emblematic of financial acumen, also underscores a systemic vulnerability, the reliance on the repo market for liquidity, and the cascading repercussions that scarcity in this market can precipitate. This understanding brings us to a pivotal realization. In a financial ecosystem where minute discrepancies can cascade into significant market perturbations, the sanctity and stability of tangible assets like silver become increasingly paramount. Farber's discourse on the basis trade doesn't just outline a trading strategy. It paints a broader picture of market dynamics, liquidity tensions, and the perpetual quest for stability in an inherently unstable financial landscape. Connecting these dots, the anticipation of silver reaching the value of $3,888 is not a mere speculation. It's a hypothesis grounded in the understanding of market mechanics and systemic interdependencies. The potential volatility, liquidity crisis, and systemic risks underscored in the basis trade narrative amplify market uncertainty, driving investors towards tangible, reliable assets. Silver, with its dual persona as an industrial commodity and a monetary asset, is poised to capitalize on this shift, benefiting from both an industrial demand surge and an investment allure as a hedge against inflation and economic instability. In essence, the insights support the hypothesis of silver's potential ascent. They enrich it with a deeper understanding of market dynamics. They paint a picture where the intricacies of financial strategies, the quest for stability amidst systemic fragility, and the inherent value of tangible assets like silver coalesce, presenting a compelling narrative for the potential revaluation of silver. This narrative isn't just about numbers, it's about understanding the pulse of the market, recognizing the signs of the times, and acknowledging the role of silver as not just a commodity, but a beacon of stability and assurance in a tumultuous financial epoch. As we connect these insights, the initial assertion about silver's potential ascent to $3,888 evolves from a bold statement to a nuanced hypothesis, rooted in a profound understanding of market mechanics, financial strategies, and the timeless allure of silver as a harbinger of stability and value in an ever-evolving financial landscape. As the narrative we've intricately woven reaches its crescendo, let's take a moment to reflect on the profound insights we've unraveled. The journey we embarked upon wasn't merely about numbers or predictions, it was a deep dive into the complex, often overlooked mechanics of our financial system and the pivotal role silver plays within it. Silver, often overshadowed by its more illustrious counterpart gold, emerges in this narrative not just as a precious metal, but as a symbol of stability, a beacon of potential amidst the tumultuous seas of market volatility. We journey through expert insights, dissecting the basis trade and understanding the delicate interplay of market dynamics, liquidity tensions, and the quest for stability. Now, as we stand at this juncture, it's not just about witnessing the ascent of silver to unprecedented heights. It's about understanding why and how this ascent is not just a possibility, but a narrative grounded in the intricate dance of supply and demand, industrial significance, and its unshakable stature as a store of value. But let's not halt our quest for knowledge here. The horizon is vast and the journey of understanding is perpetual. In our next segment, we'll delve even deeper, unraveling more layers, exploring new dimensions, and continuing to decode the enigma that surrounds the financial markets and the lustrous allure of silver. Stay with us, engage with the narrative, and let's embark on this continuous journey of discovery together. Don't forget, your insights and engagements are the fuel that propels this journey forward. Subscribe to the channel, share your thoughts in the comments below, and become an active participant in this unfolding saga. Remember, the story of silver and the financial markets is not just a tale told. It's a lived experience, a shared journey, and you are an integral part of it. Let's continue to navigate these waters together, understanding, learning, and growing with each unfolding chapter. And as we always do, we tread carefully, reminding ourselves and our esteemed viewers that the insights shared here are not financial advice, but a sharing of knowledge, a spark to ignite conversation, and a beacon to guide us through the complex world of financial markets. Stay tuned, the journey continues, and the best, as they always say, is yet to come. As we culminate this enlightening journey, every twist and turn, every insight has led us to this moment, a moment of realization and profound understanding. The discourse that started as a ripple in the vast ocean of the financial realm has surged into a compelling narrative, presenting an irrefutable case for the potential ascent of silver to an astonishing $3,888. We've navigated through the layers of economic intricacies, witnessed the meticulous interplay of market forces, and dissected expert insights, all converging into a singular, compelling prophecy. The saga of silver isn't just about a metal, it's about recognizing an undervalued asset's potential in a world where traditional financial paradigms are being challenged and redefined. Our exploration delved deep into the mechanics of supply and demand, the transformative role of silver in industrial, digital, and green technologies, and the unyielding pressures of market dynamics. We've unraveled the basis trade, understood the vulnerabilities of our financial systems, and witnessed how silver, with its intrinsic value and multifaceted utility, stands resilient amidst these tides of change. And so, as we stand at the precipice of what could be the trade of a generation, the narrative we've woven does more than just predict. It illuminates the path to understanding, equipping you with the insights to see beyond the horizon. But this journey isn't solitary. It's a shared voyage, and your engagement is the compass that guides this endeavor. To express our gratitude and to weave you even closer into this narrative, we're offering a chance to win a kilogram of real silver. Yes, you heard that right. To participate, simply subscribe to the channel and comment, "I love Silver News Daily." Dive into this community, engage, discuss, and be a part of this unfolding story. Thank you for being an integral part of this journey. For every view, every like, every insightful comment, your presence transforms this narrative into a vibrant tapestry of shared wisdom and collective exploration. And as we part ways today, remember the insights shared, the predictions made are not financial advice, but a mosaic of information, analysis, and perspective. They are tools for understanding, not directives for action. Our discourse is meant to enlighten and inform, kindle curiosity, and foster dialogue. So as the curtain falls on today's chapter, remember, the story is far from over. The markets will continue to ebb and flow, and silver will continue to weave its narrative, one that you are now a part of. Until next time, stay informed, stay curious, and yes, keep the dialogue alive because every voice matters in the grand tapestry of the financial world.